Welcome to The Explainer. Today, we're kicking off an investor's journey. We're going to take the wisdom of some of the greats. We're talking Graham, Lynch, Kiyosaki, and boil it all down into one powerful framework to help you build your own financial know-how. Look, every single investor is going to make mistakes. That's just a guarantee. The secret, though, is to see those moments, those painful losses, not as failures, but as signals. Each one is a lesson pointing you exactly where you need to improve. If you just ignore the pain, you're just gambling. But if you stop and you actually reflect on it, well, that's how you make real progress. All right, so here's our roadmap for this journey. We're going to start with the foundation. What is value really then? Then we'll learn to read the map of the market. After that, we go on a quest for great companies, learn how to navigate the perils, and finally, build the right mindset. Let's dive in. Okay, our first step. And honestly, this is the big one. Before you even think about buying a stock, you have to completely shift the way you think. It's about changing the very lens you use to look at money and building wealth. So to find value, we have to define it first. And at its core, the price of any company comes down to a super simple, timeless idea: supply and demand. Just think of it like an auction. When a whole lot of people want to own a piece of something and there's only so much of it to go around, well, the price is going to go up. That's the fundamental law of the entire marketplace. Now this slide, this is where we see that huge paradigm shift. It really gets to the heart of what Robert Kiyosaki talked about in Rich Dad, Poor Dad. See, the traditional path tells you to focus on your income, right? Your salary. Your job is how you get cash. But the investor's path, it's all about focusing on your assets. You study hard, not just to get a good job, but so you can learn how to spot and buy things, businesses, stocks, whatever, that put cash into your pocket. That's the real difference between working for money and having your money work for you. Okay, so we've got our foundation set. Now we need a map. The market is this huge, confusing place. And if you don't know how to read the signs, you're basically just wandering around in the dark. So let's learn the languages of the market. And this right here perfectly explains the two main languages spoken in the market. Think of fundamental analysis as telling the company's story. You're digging into the numbers, the management, the business plan. You're asking, what is this thing really worth and where is it going? Technical analysis, on the other hand, tells the investor's story. You're looking at charts, at prices, trying to understand the psychology, the emotion of the crowd. It's not asking what should happen. It's asking, how did people feel? Were they greedy? Were they scared? To be a great navigator, you really need to be fluent in both. The market doesn't just go up in a straight line. It moves in cycles, kind of like seasons. And the big money, it flows between different parts of the economy depending on what season we're in. A simple way to think about it is like this. First, companies need to buy raw materials. That's your materials sector. Then they use those materials to actually make stuff. That's where industrials and tech come in. Then, usually around the holidays, we, the consumers, go out and buy all that stuff. But when the party starts to wind down and the market gets a little nervous, that money flows to safer areas, what we call defensive sectors, like healthcare and utilities, things people need no matter what. Understanding this rotation helps you see where the current is flowing. All right, maps in hand, time for the fun part, the quest. This is the treasure hunt for those really special companies that can build serious wealth over time. And it turns out there are a couple of very different but equally powerful ways to find them. Our first guide is an absolute legend. Benjamin Graham, the guy who literally wrote the book on value investing. His whole philosophy wasn't about hitting home runs. Nope, it was about playing defense. It was about making sure, above all else, that you don't lose your money. And you do that by buying solid, boring, profitable companies when they're on sale. And Graham gave us a super specific checklist. Let's break it down. First, size. He wanted big, stable companies that couldn't get pushed around easily. Second, strong financials. His rule was simple. A company should have at least twice as much in short-term assets as it has in short-term debt. That's your safety cushion. It means they can handle a surprise storm. Third and fourth, stability and dividends. He wanted to see 10 years without a loss and 20 years of paying dividends. Why? Because it proves the company is tough, that it can survive recessions. Fifth, earnings growth. Even for a safe company, he wanted to see some growth, proof that it's not just sitting still. And finally, and this is the most important part, the price. He had strict rules on what he would pay, based on the company's earnings and its assets. This was his famous margin of safety. By refusing to overpay, he built a fortress around his investments to protect himself from being wrong. But there's another path to treasure. This one comes from another genius, Peter Lynch. His whole strategy was to look where nobody else was looking. He loved companies that were boring or even a little bit gross, the kind of companies Wall Street guys would be embarrassed to own. I mean, who's bragging about owning a pineapple company? He looked for companies that were ignored, overlooked, maybe even had silly names. The big idea here is that in these forgotten corners of the market, you can find incredible businesses at dirt cheap prices, precisely because they're not glamorous. So you have Graham's safe and steady path, and you have Lynch's contrarian path. But here's the thing, both of them would tell you that it all comes down to one critical question. Because you can find a perfect company, but if the wrong person is steering the ship, it's going to sink. The quality of leadership is everything. The sources called this the 100x alchemist. I love that term. It's that rare manager who can turn a good company into a legendary one. And how do you spot one? The biggest clue is to find leaders, the CEO, the people on the board, who own a ton of the company's stock themselves. When their own money is on the line, right next to yours, you know their interests are aligned with yours. They have skin in the game. All right, every good adventure map has that little section in the corner that says, "Here be dragons." And the investing map is no different. If you ignore these risks, you're gonna get burned. So let's talk about how to spot the dragons before they spot you. The first dragon, and maybe the scariest one in our world today, is obsolescence. This is when a competitor comes along with a new technology that's so much better, it makes your company's entire business pointless, almost overnight. I mean, think about Apple. The iPod made satellite radio look ancient. Then iTunes, and later streaming, completely wiped out Blockbuster. It didn't matter how well Blockbuster was run, the world had changed underneath them. This quote is the setup for one of the best analogies ever. The turkey. Imagine you're a turkey. Every single day, this nice human comes and gives you food and water. For 1,000 days, the evidence keeps piling up. This human is your best friend. Your confidence in a long, happy life is at an all-time high. And then, the day before Thanksgiving comes, and your entire worldview gets shattered. That's a black swan event, a risk that is impossible to see coming based on the past, but changes everything in an instant. And the map is full of other dangers too. You've got to watch out for just plain faulty information. As the saying goes, sometimes the CEO is actually the chief embezzlement officer. Then there's geographic risk. If your whole business is in California, you've got fire risk. If it's in Florida, a single freeze can wipe you out. There are also cyclical traps, where a company looks incredibly cheap right before its business falls off a cliff. And finally, a big one, diversification dangers. Look, owning 10 different oil stocks is not diversification, it's concentration. You're completely vulnerable to one single change in technology. And we have to end this section with this brutally honest bit of wisdom from Charlie Munger. It's a fantastic reminder that some parts of the market are just naturally full of hype and speculation. It's a warning to be extra skeptical with businesses where it's hard to tell what's real and what's just a good story. Some parts of the map are just best avoided altogether. Okay, we've laid the foundation, we've learned how to read the map, and we've marked where the dragons are. The final leg of our journey is all internal. It's about building a mindset that doesn't just survive the chaos of the market, but actually gets stronger from it. Okay, this experiment is just mind-blowing. They gave people a coin that was rigged. It would land on heads 60% of the time, so you had a clear advantage. And yet, nearly a third of the people went completely broke. And get this, 2/3 of them bet against the odds at some point. This is perfect proof that just being right isn't enough. If you don't have a disciplined strategy for how much to bet, your own psychology will trick you into losing, even when you should be winning. So how do you protect yourself from your own brain? Well, with a little bit of math. This is the Kelly formula. It's a tool that helps you figure out the perfect amount of money to risk on any single bet to maximize your growth over the long run. It weighs your chances of winning against your chances of losing. For that 60-40 coin flip, the math said the perfect bet was 20% of your money each time. If you bet more, you risk blowing up. Bet less, and you grow too slowly. It's a mathematical guardrail that protects you from your own greed and fear. It proves that it's not just what you bet on, it's how much you bet. So, this all leads to the ultimate goal. It's not just about being robust. A brick wall is robust. It can take a punch, but it doesn't get any stronger. The goal is to be anti-fragile. Think about nature. A forest fire is a shock. It's chaos. But afterward, the forest grows back even stronger. That's anti-fragility. An anti-fragile investor doesn't just survive the chaos and volatility of the market. They're set up to actually benefit from it.
to learn from it, and to get stronger because of it.
And that brings us right back to where we started. That simple formula: pain plus reflection equals progress. You have the map now. You know the foundation, you know how to read the signs, you know where to hunt for treasure, and you know which dragons to avoid. The rest of the journey, well, that's up to you. So my question is, what's the first problem, the first painful lesson that you're going to reflect on to make your own progress? The quest is officially yours.